If you're going to raise money for a small company that's really at the earliest stages, or a company that's raised a little bit of money but sort of going to the next stage, traditional debt without being convertible into equity is usually just too expensive, because the risk profile is just so high that a lender would charge 25% interest, right? It would just be way too expensive. So in order to raise money to start a business, frequently a debt instrument is used, but it has to be convertible into equity in order to make it palatable for the investors. So today we're going to talk about what is convertible debt, when should I use that instead of equity, and what are the market terms for convertible debt. Yeah.
I don't know much about the risk, because we discussed 2 weeks ago the whole purpose of incorporating is to have limited liability, right? But when we apply for just ordinary business credit,
yep.
right? Typically we're asked to guarantee the loan. So how exactly is it limited liability if the owner is guaranteeing the
It's not. So like for example, you don't, in a lot of things you don't have to, right? So the places where we see it common to have to personally guarantee is really leases, if you're signing a long-term lease, but that's why spaces like this exist. And now there are a lot of short-term leases, right? So that you could really do for a startup month to month. But yeah, if you are ever guaranteeing something personally, it's not limited liability. The idea of again, you could probably take out a loan if you were to personally guarantee it. It probably would be at some rate. Even if you think about credit card rate, right? So there are rates, right? And some people do that. I mean, some people fund their company by taking out credit card debt, but that's your personal debt. So, that's, absolutely, you can do that. You can take out a, second mortgage. You can do whatever you want to raise money. But if the company is going to raise money, you shouldn't have to guarantee it. And so, and that's what we see. Is investors that are familiar with this space, that are looking for upside, looking to be involved, they don't require personal guarantees. Real estate's really the place where you see it the most. Okay, so there we go. Okay. So what is convertible debt? Convertible debt is really a loan with equity features. So if you think about debt, there's principal, maturity, interest. It has all of those features. The debt claim is priority against your assets, right? So the lender gets it repaid first. And then you end up having some equity in that the principal and sometimes the accrued interest can be converted into equity. The conversion could be at the option of the note holder and or the company, right? So when does it become equity? And then it's often convertible not at equity that you have today, but that equity you're going to issue in the future. They want to tag along to future terms. And so those are really sort of the typical features, which are just a core debt. It looks like a note, and then it's going to convert into something, and you have to describe what that something is and when it's going to convert. And that's what we're going to talk about today. Does that make sense sort of at a fundamental level? Okay. So when should you use convertible debt instead of equity? So the advantage of convertible debt is that it's actually very easy to paper. It really is those fundamental terms. There's a handful that we talk about, but you basically, someone gives you money, you say, here's the interest rate, here's when I have to repay you, and you convert it to equity. And because you don't have to negotiate all the terms that go with equity, it really ends up being much easier to negotiate because there are fewer things to discuss. The other thing is that for a company, you don't need to set a valuation. So if you think about any equity that you have to sell, there's an implied valuation of your company. So if someone's going to give you $100,000 and you're going to give them 10% of your company, then that implies a valuation of $1 million after the money comes in. Similarly, if you were going to give them 1% of the company, that would imply a valuation of $10 million. And so no matter how much money someone's going to give you for equity, you have to set a valuation. And there's a purchase price, and it has to be relative. And so a lot of times at early stages, it's just too difficult to set a valuation of a company. Because if you think about it, if you've been working on something and maybe you've spent $10,000 of your own money, you really have this nugget of an idea, and you wouldn't dream of selling that for more than, for less than $5 million or $1 million. But no one's going to buy that yet for $1 million. No one's saying, oh, where you have it right now, it's worth $1 million, because it's still in those early stages. And so what happens is there's just a huge disconnect in terms of how much money what percent of the company a founder is willing to give versus what an investor is willing to take. And a note allows you to push that off a little bit. It says, we will decide that down the road. It also maintains control by the founders. So if you're starting a company and you only have debt, then those note holders don't get a vote, right? So they're not stockholders. You don't have to run things by them. They have a lot fewer rights than stockholders in terms of certain information, in terms of what you have to worry about. The cons is that it's not a price raise. So for example, if you were raising money, so you're raising $500,000 and you could get a $5 million valuation, well, that's great, right? Then you sort of set your company on a track. You say this is what it's worth, and then you can move from there. And that's actually a very clean way to do things. The other thing is that it usually converts at a discount at the next round. So what ends up happening is that they put in money now, but they come in less expensive in the future. And then the last thing is that a lot of times it includes a cap, which basically says that no matter how well your company does for your next round, these investors won't pay more than a certain amount. So let's say you can't figure out a valuation. You say, well, I wouldn't sell it less for 1, but I think it's worth 10, and the investor says, I think it's worth $500,000, right? You're sort of going back and forth, and you say, okay, well, we hit it out of the ballpark, and what if you raise your next round at $20 million? And the investor was supposed to get a discount so that they would come in at, let's say, $15 million. The investor says, no, I'm not going from 0 to 15. I want to come in only if it's $5 million. That's as high as I'll go. And so a lot of times you have this disconnect as to what the note holder is going to invest the next round, as opposed to your other investors. And so there's this, if you could actually get them to do equity at $5 million, sometimes that's better, because then you set a round and then your next round is higher. So the real uses for debt are at these early stages when you don't have this valuation and you want to do something quickly. Okay, so just want to talk about the market terms for convertible debt. I think I'll also explain a little bit about what these things are. So these are the terms of the loan. So these are the terms, and we just took these from our term sheet that you have, and these are the debt features. And so you basically need to know the aggregate amount, how much you're going to issue, not just to this current investor, but all investors. The proposed minimum investment. So let's say the aggregate amount, let's say you want to raise $500,000, it would be $500,000. And then you say the minimum investment is, I'll only accept, $50,000. If you want to give me $10,000, I'm not going to accept that. That's too small. So $50,000 and above, and sometimes it even is how much you would accept in the aggregate. So I'm going to raise up to $500,000. Each individual has to give me $50,000, and I won't close unless I get $200,000. And so those are the types of things, because when you're going to investors, they want to know that what other money is going to be in, how secure before I make this loan. What else is going. The initial closing is just when you expect to close, and the maturity date or the due date of the notes is tied to that. So these are very short-term, or not very short-term, they're relatively short-term loans, typically 12, 18, or 24 months, just enough time to get you off the ground and then raise your next round. They're not supposed to be for a very long time. And that maturity is tied from that initial closing. So if you started raising today, and let's say you closed March 1, and it's a 12-month note, it would be March 1st, 2015, it would mature, even if somebody came in, 3 months from now, because you took some money in there some money later. They do have an interest rate, but because interest rates generally are so low right now in this market, they've really been squeezed down. I mean, even 5 years ago, 4 years ago, they were in the 6, 7, 8%. We really see no higher than 5%, and frequently 1, 2%. There is a statutory minimum, this applicable federal rate that you can look up online, but it's just extremely low right now because just interest rates have been kept so low since the financial crisis. And then as we talked about the due dates of the note, which is obviously just maturity, and you have to figure negotiate that. So that's all actually very basic, right? So if you were to lend me money, these would be the terms of the loan. It's just very basic of when how much are you lending, what's the interest rate, how much should I pay you back. So then the more complicated part of these are how do they convert, right? So now we're talking about the equity features, right? So those were the debt features that are just a regular loan, but how does it convert? And they usually convert upon something that's called a qualified financing, and that's not necessarily a formal term, but it's generally used. Almost all the law firms use that term or something very close. And that basically means that it converts if there is a financing of a certain amount into a certain type of security. So usually it's preferred stock, and usually there's a minimum. So let's say you raise $500,000, they say, I'll convert if you raise $1 million in your next round. So if you get a Series A investment, then I will convert into equity. But if you don't raise that much, I get to stay as debt, because that's better for them. They're more senior, they'll have the maturity, they have these other protections. And so it's important to think about that number, what you can actually hit in the next round, what makes sense, for them to convert, and what the investor will tolerate. The discount to purchase price is basically what they say is because I'm going to convert in at your next round, so let's say this $2 million round, I get to come in at a discount. And really what ends up happening is all equity is issued at a purchase price. And again, it's based on this valuation. So if you think about, let's say you have 10 million shares of stock issued, and the valuation of your company pre-money is $10 million, then that investor would buy stock at $1 a share, right? So the $10 million valuation divided by your 10 million shares, the purchase price is $1 per share. And that's how it's calculated, right? So if you even think about you're going to buy stock on the in the public markets, it's a price per share, right? And then you could always go to Yahoo Finance or Google Finance and figure out the market value based on shares outstanding, but that's all it is, right? Is that there's always a price per share. And what happens for these is that we say, okay, they're paying $1 per share, but we came in earlier, so we get a discount. And so frequently that's between, it's about 20%, sometimes 15%, sometimes 25%. And so what it would say is everyone else is paying $1 per share, I get to pay 80 cents a share. We have a 20% discount. And so what that means is that if someone put in $100,000 instead of paying $1 per share, which would be 100,000 shares for their investment, when their note converts, they get to pay only 80 cents a share, so they get 120,000 shares. And in fact, they even get a top up for their interest. So let's say it was a 5% interest and they collect that for 9 months, and they probably get about 125,000 shares. So for that 100,000, if someone's coming in now, they get 100,000 shares, whereas this early investor gets us 125,000. And that's the benefit of them, right? That's why people do this early, is they say, okay, I'm going to have this protection that I get repaid. If I don't get repaid, I'm going to get a benefit in the next round. Similarly, this cap on a purchase price, if you take that example that I gave you, that was a $10 million valuation, and let's say the cap was $5 million. So now you would say, okay, the valuation is $5 million, there are 10 million shares outstanding. Instead of $1 per share, I get 50 cents a share, right? So it's that $5 million pre-money valuation divided by the 10 million shares. And that's a huge advantage to investors, right? To get that cap when there's a big difference. And so now, instead of having 100,000 shares, they basically get 200,000 shares for that same $100,000 investment in that example. And the cap became very popular as, in the past, 3 to 5 years, as the market's gone up and there's been a bit of a bubble. I don't know if it's a bubble or a boom because it hasn't bust yet. So, but that as valuations have gone up, the early investors felt that they were not getting rewarded enough for taking that early risk, and so it became more and more common to get this cap and saying, look, if you take my money and you just, you hit a home run, I should get to share in that upside. And so we see that's very common. I don't know if people have any questions on that. That's sort of the fundamental math behind these notes. Okay, so then what are the conversion, the rest of the terms? So that's conversion at an equity finance, and that usually happens, right? So almost all of these notes have those debt terms. They have the terms of the loan. They convert it at equity financing. And then they also sometimes, and this is just a negotiation, can convert at the time upon a sale of a company. Without this, it means that, let's say that person gives you their $100,000, you're working away, and they have this 5% interest, and it's a 2-year note, and after 1 year, you sell the company, right? Like you really hit it out of the ballpark, you don't need to raise that much money, and someone comes and buys your company for $3 million after 1 year. Right? That's great, you're totally psyched. Well, now you have this note. Well, if it doesn't convert into equity, you just repay them, right? So they get $100,000 plus 5%. So they get, $105,000, and you get the remainder of that $3 million. And so a lot of investors say, well, that's not really fair, right? That's not really the idea here. My upside isn't that 5% interest, otherwise I'd charge a lot more interest. I should get some part of that. And so what happens is they say, okay, if there is a sale, and you sort of define what a sale is, which usually what you would think is, 50% of the company, is that we get something for that. And there are 2 ways to do that. One is you can give them a fixed return. So instead of $100,000, they get $200,000 back. And that's very common, or $300,000 back. So no matter what you sell it for, they're just going to make 2x their money or 3x their money. And that's very simple. The other way is to say you would convert into common stock. So again, the person giving you $100,000 says, look, if you hit it at the ballpark, I should get 10% of your company because you're taking this investment, you still have 90%. We should share in that together. And so in the example where you sell the company for $3 million, they would get $300,000. What's interesting about this term is that this is one where many founders actually are willing to be the most generous. So, because most of them feel like the guy who gives them that early money, if somehow there's a home run, which is very rare, why not reward them, right? Like if you get $3 million, why not give the guy $300,000, right? And so, so we find this is, it's not always in there, and sometimes it's used as a little back and forth, but it's really the one where, even though you're not aligned, it's the one that's like least problematic from a negotiating standpoint. Does that make sense? Okay, so then the last thing, so again, we have the debt and, the debt features, and then the equity features are when it can convert. So the first time it converts at the equity financing, and we talked about converting at a sale, and then the last time is that it can convert at maturity. And so sometimes at maturity, you just have to repay. I don't know why we have our little legend there, by the way. We haven't had that on others, but that's where you can ignore all of that legalese. At the end of when the note is due, what you really can do is you can repay. And that's, I would say, most of the notes we see are just silent, right? So you get to maturity, you haven't done an equity financing, you haven't had a sale. At that point, there are usually 2 things. One is the company's really not doing well and it's going to go under. And this goes to the limited liability, people are just going to lose their money. Or they're on the cusp, and at that point, for the most part, the investors who make these types of investments are willing to extend the note, right? They say, okay, you can't pay today. If I call my loan, you're obviously going to go under, so I will extend that. And so most of them just end up being silent, but of course they could be, there could be other terms. So if there are other terms, what it usually says is, okay, we can convert at maturity. So we hit maturity, it's 18 months after we made it, and now I, as the note holder, or sometimes if you can get it as the company, I am going to convert you into common stock. And there are really two ways you could do that. One is you just fix the price early on, right? So again, like that 10% of the company, you just say you're gonna convert into those shares of common stock that you decided early on, or that you figure out what else has gone on at the time and then you calculate it based on a valuation at the end. It doesn't really matter. In fact, it doesn't come up that much. I would say the majority are calculated at maturity so that there's less room, really to play games. But that's, that's what happens. And so, and then the issue, what happens, the reason that this is not that common is that debt holder now has common equity. It is equal with you. It's equal with the founders. And it's not ideal for them because they don't get their money back first. So they've put in money and now they've lost that priority. And they will only have 10% of the company. So we see this negotiated for, but it rarely is that you have that note holders elect to convert. Almost always they would rather sort of be held out there as debt that's basically in default, but they're just not collected on. Those are really the terms. I don't know if people have questions. This tool is very common in the tech world, for startups that need small amounts of money early on. We haven't seen it as much in what you are doing, but I think it will, as the market for life sciences and biotech matures or grows in New York, I do think that this will be a tool that's used more and more because it allows you to get money in more quickly and it allows the investor to be relatively protected, considering it's a high-risk investment. And so it's a very useful tool for companies and investors. And so there's no reason that it wouldn't spill over to this market, is my guess as to what will happen. But, haven't seen it yet.
Of course, the presentation is geared towards a situation where the investor is professional investor.
Yeah.
Is this instrument useful in the case of soliciting investment from people who are, with angels, soliciting angel investors who are not necessarily full-time?
I actually think it's even better for them than equity because the thing is that it's much more understandable, right? You guys tell me if it's understandable, but usually it's fairly basic. This idea, I'm giving you a loan, like if you think about someone has a rich uncle or their father, their grandmother, right? All those family money, they don't want to buy common stock or preferred stock. They don't know what that is, right? And so if you think about and I'm using that as a family member, as a layman, right? But you say, okay, just loan me the money, but if the company does really well, then I'll give you some of that upside. And they're like, oh, okay, that I get, right? It's sort of like a concept that people get, right? I loan you money, and then if something really great happens, like a sale or an equity investment, then you're going to get some of that equity. We have found that a lot of people really understand that, much more than even the most streamlined, seed preferred stock, terms. We find that people who are not regular investors find that way more confusing. The other thing is this valuation issue. So that if you have someone who's not a regular investor and you say, my company is worth this, or you're getting this percent of my company, that usually really stalls people because they're just neither the founder doesn't really know how to value it, and someone who doesn't do this for a living definitely doesn't know how to value these companies, right? It's very, very difficult. Even venture capital investors barely know how to, right? That's the skill is how to value when you're coming into Twitter too late or too early, right? When you're coming into Facebook too late or too early, when you're coming into, Opsotech, right? Too late or too early, right? And that's all valuation questions. So valuation is very, very difficult for people who aren't regular investors. So that's what we found at least.
But aren't you just putting it off? Like you mentioned
Yes, yes, but you let the institutional investor do it. Right, so again, that's why I say that conversion at maturity is the least one. The other two scenarios, right, so the three scenarios where you convert, one is at maturity, where there's no third party, but a conversion at a sale, right, is someone's buying you, so, Abbott Labs is setting the valuation. The first one is conversion at a preferred stock financing, Polaris is setting the valuation, right? You're leaving it to the pros, for that reason, right? So you're saying, okay, you will get equity, but let someone else negotiate that with me. Someone else who knows what they're doing, who does this all the time.
And just to speak more to your general experience as opposed to the specific with the last place. So one piece of advice which at least people in our situation often receive is that you should pick your investors very carefully and pick investors who have interests and financial interests, but also working work style and general interests that are well aligned with yours. And the other piece of conventional wisdom is that when people own a piece of something, they're more invested and motivated to put a lot of energy into it and succeed. Do people who hold convertible notes, in your experience today, have this kind of attitude about a company that's similar to if they were to actually own just 10% outright, or is there kind of a psychological difference there?
So I guess that's an interesting point. Yes and no, right? So I think some people think I'm a lender and therefore it doesn't matter. There are some people that say this person has 100,000 of my dollars and I care, and and that's very important. But I have to tell you that we find that even in equity investments, there are investors that are involved and investors that are not involved. So I would say yes and no. I'm not sure it's so much the instrument as opposed to the investor, and the benefits of getting them in and closing quickly usually outweigh that, person. The other thing is that a lot of times founders want to push back and say, I don't want you on my board of directors. I don't want you that involved because it's so early stage. And so if you want someone to be even more involved, you put them on your board, right? You give them some control, and it's still easier this way with a note. That's what we found. But yeah, it's a little mixed. I think it really is a little bit of a style on what people do. The more regular investors and people who are more involved tend to do equity, but they tend to know those terms. But a small equity round, let's say you raise $500,000, if you're not doing that with someone who knows what they're doing, it just takes forever, and I think next we're going to talk about equity terms. Even the most basic equity, there's something called SeriesSeed.com, and you could pull those documents off the website, and that's what we recommend people use. Even that, right, we're saying these are middle of the road, they're not company favorable, they're not investor favorable, these are terms, there's almost nothing to negotiate. People end up spending a lot of time negotiating and not understanding, so at least that's what we found. But if you can get it, if you can get someone to, if you can get that valuation, sure, an equity round is great, the right amount of money. Do other people have questions about this? Have you guys seen these rounds?
So why do you think convertible debt is not really popular yet?
Yes.
The biotech too.
That's right.
Is it known and used in Silicon Valley or Boston area? It's just not known here in New York, or can you comment on that?
Yeah, so the issue is that it's not good when you need to raise a lot of money. So it's not really the tech or biotech, it is mainly the amount of money you need, right? So biotech is actually used very common, but just not in the seed round, it's used as a bridge round. And it's exactly the same, right? So someone raises $10 million, they've run down to fumes, and they need to get to their Series B, and they will use convertible notes a lot. They're just assets at that point, but it's really the same term. The issue is that with a tech company,
I'm sorry, you say they're just assets. They're using the infrastructure of the actual company to guarantee the loan, as opposed to
or it's just So sometimes there's security interest. So sometimes you would be sort of a secured lender, but the main thing is that people feel that they're de-risked, right? There's some more there than just forming. The issue with these is that someone's giving you $500,000 and you have to show something that's $500,000. And typically, biotech, you haven't been able to show much for that, right? You just need way more money than $500,000. And so, but I have seen, and maybe you've seen it also, what you guys are starting is that people are doing different, more creative, biotech business models. People are licensing things out more from universities that are further along. They're taking things that are, the clients that we work with, not a lot of them are still within the realm of biotech, but aren't necessarily, something that needs $10 million for FDA trials right off the bat. And if you have a company like that where $500,000 really could be used, then I definitely think, or $100,000 or something up to $1 million. Although we've seen larger rounds. But yeah, if you have something, a product in healthcare or something that you can license, something that doesn't need FDA approval, something that may be bordering on a medical device but isn't quite a device, then this could be a very useful tool. But if you need you need several $1 million just to show any progress, then this won't be great. But that's my instinct, is that this will come. This will come more in New York. As we see more of those types of companies. And I think that's a lot of what's going on here in these companies. You guys tell me what you guys are with that piece. So I do think that they'll come. And then again, it is a term that if you ever raise a Series A, this could be used as a bridge. It's a very similar term. Usually they're a little more punitive if you don't raise the money, right? So the bridge, they're coming in and there's already a lot at stake, and they say, you have to pay me back, and maybe they get 3 times if you don't, and things like that. Or a bridge to, a sale of a company. They're not uncommon. So. Does anyone have any other questions?
How do you determine the value of a company? Is it something like projected revenue, let's say in 3 years times a factor? This is given by experience, or how do you come up with a number?
Yeah, so that's why it's so difficult. At the early stage or later on?
Let's say, well, 2-3 years once the first product is out, we are ready to sell. But then basically we don't make that much revenue yet. But we can we have an estimate how much we would make. Yeah,
so then it's very complicated, right? It's a lot more art than science. You think about companies that have sold for billions of dollars on zero revenue, right? Many companies, especially in biotech, if someone's going to take you over right before an FDA approval or invest in you, to get the bump up from an FDA approval, it's a probability, and it's based on how much revenue you can get from that and where the progress is and the trajectory. But in biotech investing, as you know, that's why it's so boom or bust, right? You see things explode or they become zeros, explode or zeros, right? And so that's just very difficult. And that's based a bit on revenue, but it's based on market size and then, the bottom line and where you are and how close and how risked you are. But revenue is just one part of the story there. And it depends on the business again. So there's all different types of businesses. But that's why valuation is so hard. Valuation is extremely difficult, and people get it wrong all the time, right? That's the name of the game in these private companies, especially in biotech. You see a lot of up rounds, down rounds, up rounds, down rounds, right? So people took a bet that that approval was going to come, or test results were going to come in a certain way, and then they don't, and the next round isn't as good, and vice versa. People come in low, and then they hit it out of the ballpark, and or a competitor sneaks out, right? You had no idea someone else was doing something similar. Although it's less common, in biotech, people tend to know people in their space, and so even though people might be very, stealth, it's a little more.
What are the accreditation requirements? So, if someone were to come in and make an equity investment, they'd have to be accredited.
Yes.
Does that have to be the case at the time of the note issuance as well? Or?
So we tend to want them to be accredited at the time of the note for 2 reasons. One is that it's true. So they are securities, right? And so you would have to, you're selling them under the securities laws. But you want to make sure that when you sell them, when they convert to stock, when they're making that investment decision, that they're an accredited investor. Otherwise, they are entitled. One of the worst parts is that you have to give them financial statements, etc. The other thing is that you really don't want people who care about the money. Like, if someone's giving you $100,000, like that should not be someone's like college savings, right? That should not be retirement. That should be for someone who's wealthy enough, and there are enough people where they don't care about losing it because it's very high risk. And that's difficult a lot of times for founders because they think they're doing people a favor, right? Like, so they want to let all their friends and family in because they have the utmost confidence. But you really only want people who can write very large checks without feeling any pain when you call them up and say, it went under. That's, I know, you have to meet that. That is what we will be doing. You will be doing here. Is bringing them here. Hedge fund people, right? That's who you need.
Just wondered about sorry, to the gentleman that was asking about how much the company is worth. I've been invited to a webinar that is entitled "What is your business worth?" And if you're interested in my forwarding it to you, just come and talk to me afterwards.
Thanks.
Yeah.
So,
Good.
I won't be there, but if you're interested.
Yeah. No, it's very complicated. You spend a lot of time figuring that out, and I think as many metrics as possible to figure it out will help.
If you're using convertible debt as the
Yep.
first money you're bringing in,
Sure.
how can you? What aggregate number would you start with? If your company, let's say, in your mind might be
Yep.
worth millions in a few years, but you really don't have anything to base it on, or there might not be any comparables to your company out there.
Yep. So you mean for what purpose?
Like just for raising
How much you should
how much
raise?
you should be raising.
So the how much you should raise is more of a budget than of how much it's going to be worth. So the maturity of the note, right? So that's 12 months, 18 months, 24 months, is so that you could raise the next round. And so you want the amount of this note to be enough to get you to that endpoint plus a little bit of cushion. So if you say, okay, in order for me to raise my A, I need to do these 10 things, and those 10 things are going to cost me $150,000, right? So I need some consultant time, I need lab space, I need this, whatever it may be. And then you say, okay, well then I'd like to, and that's all I can do, right? Because I can't spend more money because there's some linear, right? So even if you had $10 million, you can only spend 150, right? You try to raise 250. Right? So 150 and then a cushion for you to raise, right, would be ideal. But if you said, look, I could really spend $400,000 and then, so instead of having 4 people on my team, I'd have 6 people on my team, or instead of having 5 hours of lab space, I'd have 20 hours of lab space, then try to raise 400, but again with a cushion, and then try to raise 500. But that's how people think about it. Is how much could you spend in that time frame that makes sense, and then just add a little bit of cushion. And sometimes you can get that cushion and sometimes you can't. But that's usually, it's really just a budget that the maturity should line up with your spending. And again, you don't want to overspend, right? So like if you really need the results of A to do B, don't do B simultaneously because that's just bad business, right? You're also doing a business. So it's not just, how fast. There's this saying that 9 women can't produce a baby in 1 month, right? So it's this idea of some things have to be sequential, right? Like you just need 9 months with one person, right? And so it's the same thing. If you can't, sometimes spreading it out helps and sometimes it can't. And that's really important for people to look at. Like sometimes, it could accelerate a little bit, but sometimes it can't. Is there any other questions?
So I have one general
Yeah.
point, which is, you said you could see convertible notes becoming more popular, but what are some other interesting financing experiments that have been happening that lead you to believe that changes like that could be?
I think one of the things is what I have seen with the companies that we work with a lot are not, the biotech in New York is not just this new chemical entity and I need $50 million to get through FDA approval. So if people are starting other types of companies that are still life sciences, that they will need less money. And I do think, I was sort of being a little facetious about the hedge fund people, but that is actually, hedge fund guys, mainly guys and some women, but have made a lot of money taking risk. And a lot of that risk happens to be in life sciences, right? I mean, all these SEC, trading, right, is insider trading, it's not life sciences. And they are people who come into tech companies, and I think they can come into, life sciences companies, but it needs to be something that they can understand, right? That they can, sort of have bite size. And I think that as this market, that's how the tech industry sort of came, was that you had a lot of finance people that put money into companies. If you have the companies, I do think you're in a market where money will come in smaller tranches, as opposed to just from big institutional venture capitalists. And you really saw it in the tech, and I see life sciences being like 5 years behind tech. I don't know where you see it about, that sort of where this movement is probably about 5 years, behind where the similar movement was in tech. And that's how I would see it. And so that I could see for you, if you have more, projects that require less capital outlay, that this could be a very good instrument, and that people like to, people have a very high risk profile in New York and have made a lot of money. Over the past, as we all know, right? Over the past 10 to 15 years, there have been a lot of people in New York who've made a lot of money and are willing to invest. And so that's how I see it coming, sort of an ecosystem. And we definitely saw that in tech, right? So 5 years ago, you didn't see that many notes, you didn't see as much seed investment, and it's just catapulted. And as most of you know, New York is now, the second biggest market for VC investment, behind, Palo Alto, Silicon Valley, so ahead of Boston, ahead of any, Austin, anywhere else. And so there's no reason why we can't be there in life sciences. So.
Couldn't agree more.
Exactly. Anything else? Yeah.
So the life cycle of a biotech company is much longer than that of a tech company.
Sure.
So how do you convince investors to kind of push them that the gains are not going to be immediate, even if you want them to? So are there any particular pointers that this might be very new to?
So I actually don't think it's that much longer, right? I mean, really, tech companies don't make money for 7 to 10 years in bios. There have been the few that you see are really exceptions, and even honestly, Facebook, right, was 7 years before it went public, so and that was basically the quickest ever, right? So, to get to where it is. I mean, a lot of these companies take a lot longer than people think from that initial investment to where it's making money. They're just very sexy and high profile exceptions to that rule. But like a Snapchat or an Instagram, in my experience, those are real outliers. And if you look at the companies that go public, they've usually been around a lot longer. You just might not have heard of that for as long. So I think that the investment profile is about the same in terms of timing. The difference is definitely the quantity of investment, right? So although you're now seeing hundreds of millions of dollars being poured into tech companies, but the tech companies have been able to start with less money. Although you're seeing that really change as you get more substantial tech companies that aren't just an app or a website. So, a Box.com or something. I think they raise a lot of money. Dropbox raised a ton of money, to get where it is. Guild Group raised a lot of money, for infrastructure. So you're seeing hundreds of millions built, by these tech investors. The issue, the one thing that is very different though, between life sciences investing and tech investing, and this it's a little more binary, right? So in tech, a lot of times there's a problem, and that can be solved by many people, right? So whatever Instagram did, I'm sure there are lots of programmers out there that said, I could have done that, right? And then it was market traction, right? And then it's a chance, right? So I worked for many photo type companies, apps, and none of them were Instagram, right? And so there's a lot of people who are in and around that space, and it was market traction. In life sciences, what you find is that if you could cure X disease, it's binary. You're going to do incredibly well, and if you don't, then it's you know what I mean. It's not so much the market traction; it's can you solve the problem. And so that's a different type of investing that people have to get comfortable with.
Yeah. So on that.
Yeah.
So in tech companies, you can
Yeah.
really use the hackers approach.
Yes.
So I mean, like you said, what people can the final product is more apparent to the investor, but the biomarkers that you use in life sciences is not exactly apparent.
Exactly. Yes.
So there is no way to get past that.
Yeah, so that's just how, you have to get people excited about your thinking in a different way. And again, that's why I think some of these people who are and I don't know who's going to come, right? So there have been typically investors in life sciences who know that space, but you could see people who like complicated problems, who don't like the vagaries in the market, who could say, okay, show me your science, show me what the field is. And then there are a lot of people that just would prefer investing in life sciences, right? They like the idea of doing something that's a little more, good for society and helpful, and there's lots of other emotions that go along with that. We're also seeing, it's interesting, we represent a fund that makes, very early stage, life sciences investments, and they haven't done a lot in New York, they've done it elsewhere, they're going to start doing New York, and we represent a fund that actually provides very structured loans to medical device companies that have a product and sort of need to get to the next level. Again, a little bit later, but both in New York, right? We represent Optotech, which went public, New York company. So you're starting to see, and if Optotech, for example, it's already been huge, but let's say all those guys make a lot of money, at that company, they'll come out and they understand it, right? They have a macular degeneration drug, right? So that's heavy science, lots of money gone in, big ticket, right? Those are the types of people that you need here. Again, we represented Millennium Pharmaceuticals way back when. It was 4 women formed up in Boston. They have created a reign, just rained out new founders up in Boston that continue to use us. That's how we see it, right? And that was because they built up that company, went public and sold for $9 billion, and they just created a lot of wealthy scientists, right? So people who understand that metric. And that's where we're just a little bit behind. But it's the same thing in tech in a certain way. When you have people who are in finance their whole time, or a public company, and they don't understand, like, I have an app and it's all about eyeballs, or I'm going to take, operational efficiency and I'm going to create a new way for people to do business, or I'm going to, like Warby Parker, I'm going to disrupt eyeglasses. Like, people haven't spent their time thinking about that, and why is that big, right? Or, the razor company, right? Like, I don't know about razors. So people are, and you convince people. I have someone who's making Highline coffee. They make, coffee pods, like, that go into, like, an espresso machine. And, why, people haven't thought about that, but they sort of get, like, okay, how do you bring them over? But yeah, life sciences investing is very difficult because of all that. Because most people are like me, and we don't really understand, and everything seems amazing and impossible, right? Like, so all science is like, wow, that's amazing if we could do that, but no way, and so that's, that is the hurdle.